this and collecting cash, reducing accounts receivables. Okay, so this reverse entry here, recovery entry also has two of them. Accounts receivable increased and then immediately decreased because we're collecting cash. So in the case of direct write-off method, if all the customers are paying money on time, then basically you will not be identifying anything. You'll not be writing off any accounts receivable accounts. You'll not be recovering anything. So under direct write-off, if all the customers are paying on time, there will be no journal entries to be recorded other than sales revenue on accounts, service revenue on accounts. Earlier that transaction happened. Later there will be nothing recorded under the case of direct write-off. But allowance method, even though all the customers are paying on time, we still do an estimation just to be more conservative. Okay, this estimation entry always occurs for allowance method. This is the whole purpose of allowance method. Okay, we do an estimation up front. Okay, any questions for these two methods before I move on to notes? Okay, the core of this first part is that we want to make sure that companies represent on financial statements the appropriate amount of accounts receivables. That's the whole purpose of doing this. Okay, because a part of it we noticed from last year's prior year experience, a part of them may not be collected. So we estimate them based on total amount of credit sales or the age of the accounts. So this estimation always happens first, and typically it's on a monthly basis. At the end of the month, companies will do this estimation based on % of sales. And if they combine with this last method, usually this happens at the end of the year. You will prepare a table of all the age of the different accounts receivables. Okay, then later on we'll be identifying the accounts that are past due, that we did not collect from customers on time. And then when companies transfers these cases to their attorneys, they write off these accounts receivables, just so that we don't overstate accounts receivables on the statements. Later on, in case customers pay back the money, then we recover the accounts. Okay, so there's really 3 steps to this. Under direct write-off, there's no estimation. Just by its name, we only directly write off the accounts when we identify bad debt customers. Okay, once we identify them, write them off. Later, if customers do have money to pay us back the accounts receivables, then we erase previously entry by flipping it and then do a regular cash collection entry. Okay, these are just some of the cases that may happen. The majority of the accounts usually will be collected after you make sales and services on account. Later on, customer just pay back the money on time. You just have this entry, cash collection, accounts receivables. In some cases, you may have bad debt customers. You have to recover the entries. This is what would happen for those cases.